Hi, I'm Lena Rao. Welcome to the TechCrunch TV studio for our Ask a VC series where we put VCs in the hot seat. I am joined today by Rich Wong, partner at Accel Partners. Thanks, Rich, for joining me today.
Thanks, Lena, for having me.
I want to go into your bio a little bit. As a partner at Accel, you focus on software, mobile, and internet services investments, and you've helped lead the firm's investments in Angry Birds, Rovio, the parent company Atlassian, MoPub, which is in mobile advertising, Dealer.com, Quilt, among others. So, clearly a lot of mobile there. I'm really fascinated with, we've talked a lot about mobile, and it seems like we're there, and we've been talking a lot about how, there's this sort of next wave of innovation in mobile. And are we past it? Like, what is the next wave of innovation in mobile? Since we've, already sort of gotten to all these these interesting gaming and advertising and so on?
Sure, absolutely. So, somewhat sadly, I've been working in mobile for 12 years, back into the dark ages, when there were no color phones or when there was only sort of 4 green and black screens. So 6 years as an operator and now 6 years at Accel. And what's amazing about it is a lot of innovations occurred just in the last 4.5 years. So the T-Mobile G1, which is the first Android phone to ship in volume, only shipped at the October of 2008. So it's literally been under 4.5 years that Android has even existed at all. And all the ideas and innovations that have been thought of for the last 10 to 15 years, location services, check-ins, mobile commerce, advertising, are only just starting to be reality right now. So we can talk about each of the subcategories if that's helpful, but whether it's mobile advertising or whether it's gaming, or there's been a lot of discussion about mobile commerce, I think each of those areas has at least another 5 to 7 years of innovation, pretty much starting from where we are, right now.
Well, I'm curious, on the mobile enterprise level. I mean, you're an investor in Atlassian, which provides developer tools, sort of high-powered developer tools and collaboration tools for businesses. Where's the opportunity in mobile on the enterprise front?
Absolutely. Maybe to set a little context, I think for the last 5 to 6 years, most of the money has been made in mobile around sort of the consumer-led things. So whether it's Quattro or AdMob in sort of the mobile advertising space, or NGMoco in gaming, and you sort of see the next generation of those things in the forms of Supercell or Rovio or companies like that. The consumer-led side of it, for whatever reason, was what sort of drove a lot of the activity and the adoption over the past 5 years. But now that we're at the scale that you see in terms of people bringing, Android and iPhone devices into the office, I think there's a major revolution happening on the enterprise side. That Sundar talked about the 900 million Android devices at Google I/O yesterday, and again, that was in that short 4.5 years. Okay, so to answer your question specifically, in the enterprise, I think there's a whole range of productivity and security things that basically have not yet been addressed. You have a bunch of things that are trapped in the pre-mobile phone era, in sort of the PC era, that are sitting on legacy systems that are basically attached because of either security or privacy or data leakage reasons, pretty much to the laptop, or even in some cases to the desktop, and be able to get that information out to where the knowledge workers need it, to their mobile devices, while doing it in a secure way, is, I think, one of the major opportunities. So you may have seen that TechCrunch covered this morning that we invested in one of the leading enterprise mobility companies called AirWatch, and we invested $25 million in them. That was announced just this morning.
Right, and they had previously raised $200 million,
$200 million from Inside Venture Partners. We're very honored to be a small part of working with them on that. There's another company called Mobilespaces that does a virtualization layer that allows you to separate, containerize enterprise data and consumer data. You guys have had John Herring from Lookout on this show quite a few times. Those are 3 examples of, I think, innovation happening on the productivity and enterprise side that we're now seeing really take shape in mobile.
I want to switch gears a little bit to our one of our audience questions, and you've been doing this now for quite some time, being a venture capitalist. So this question, I hope it doesn't take you, a little bit off guard, but what percentage of investment is it normal for a VC to take? Percentage of a company, is it normal for a VC to take? Is it 40 to 50% in a company? Is it 10% in a company? Maybe we can address it at like the Series A level.
Yeah, absolutely. So, it's a classic, your mileage will vary depending upon your strategy and the sector, but all those caveats aside, I think it's relatively straightforward. I think a Series A investor who you really want to be a board member and work with the company realistically over 7 to 9 to 11 years, we'll generally try to target something with a 2 in front of it. So 25% might be a rough goal of what one's trying to achieve. Now, that's simply put because in future rounds, obviously there's going to be dilution, and you're trying to own hopefully 20% plus at the end when the company is IPO'd or acquired or otherwise. That's certainly a goal that many of us have. Now, there's times you want to own more. You try to own 30, 35% in some cases if you're really leading or co-incubating an idea or really developing it with the entrepreneur. And there's certainly times that we certainly own much less. I think it's pretty public what we owned Facebook at the end. And that obviously worked out quite well, but Accel never owned more than, I believe, 12% of that company, and that's just fine.
Well, that's an interesting sort of angle for startups to be thinking about as they raise money, and how much they should be giving, and what's the benchmark for VCs to be getting.
Yeah, if I may just make one other comment related to that, I think a big part of what I think founders have to make a choice on, or diligence, is realistically what value added is there or not, right? And I think some of the cynical folks out there may say there really is no value added, and if that's the case, you should truly go for the best valuation, the least amount of involvement, or you have to decide if in certain categories or certain stages of companies, you really want someone who has vertical depth or knowledge about a specific ecosystem. In that case, you might be willing to give up a little bit more dilution or ownership from the VC's perspective to get that help. So I think one has to just make a genuine, authentic choice about, do you really want that or not? And I think that's one of the variables to consider.
I want to go to another audience question, and this is actually one we get a lot, I would say, for our Ask VC series. Can you build a great company outside Silicon Valley? And it's, we have a large chunk of our audience that's outside of Silicon Valley, so, but what's interesting about your portfolio is that you are, affiliated with a number of companies, large companies, iconic companies that have been able to create a name outside of Silicon Valley. Rovio, of course, is one of them. So what's your perspective on that?
So, I think the old saw around Silicon Valley is that you have to invest only in companies you can drive to, and I think that is way out of date. And I don't think that is at all the conventional wisdom in Silicon Valley at all anymore, with examples of the deals you mentioned and many others. So the short answer is I think, it used to be that in order to access the technical talent, the Oracle DBA or the ex-Siebel sales guy, you had to be in the location where all that talent was located. But with the advent of all the things we know about, AWS and the cloud, and the ability to do consumerized or viral distribution like the Dropboxes or Atlassians have done, you don't need salespeople, and you don't have to be in where all the data centers are necessarily. And so I think that's resulted in companies, whether it's Atlassian or whether it's Rovio or Supercell or Spotify, being essentially all over the world, Stockholm, Helsinki, Sydney, Australia. And I think, the reality is, I think what's quite amazing about it, and we're obviously biased because we're investors in some of those companies, but we believe that if you can get to the proof of the value proposition fit and some degree of scale, many of these companies are really built for long-term durability. They're built with a model that in many cases is superior to what you sometimes can build around Silicon Valley. So it's pretty painful on the travel, some days, but we are firm believers that a lot of the innovation is going to come not just in those places, but in places like Chicago, where we invested in Braintree and, as you know, Groupon. Of course. Qualtrics, where we invested in Salt Lake, Fusion.io in Salt Lake. And so I think there are many, many examples outside of the Bay Area of some defining, iconic companies, as you say.
Do you think it's about the entrepreneur and not about the location? I mean, is it like all these moving parts that have to do with like where the entrepreneur is? How many companies have they done before? Access to talent, like you mentioned before.
So the reality, I think, is it is harder, right? Because you don't have the support, you don't have the press coverage, you don't have the legal support. So I think the ones that figure it out, and hard to predict exactly who, but the ones that are able to break through and create that unique idea or that unique business model, they end up becoming that much more special, right? And I think there are times, as we know, around Silicon Valley where there are 5 of this and 5 of that, the next ride sharing or the next, and those can be very viable businesses and great businesses, but they're not fundamentally unique, distinctive businesses in and of themselves. You tend to find, whether they work or not, when you go to these cities outside the Bay Area, if they succeed, they tend to be, there's a nice uniqueness to those businesses. And I think you can see that in Supercell or Rovio or Atlassian or Braintree or some of those types of companies.
So last question, and this is more of a fun one, but how often do you play Angry Birds?
I play pretty often. I'd say I probably play, Peter Westerbacher, who I think you've met before, kind of pings me on Angry Bird Friends pretty much, daily. And so I'm required at minimum to sort of play at least once a week. So I do play
and
pretty
your kids,
often.
they probably
My kids
play
actually like Bad Piggies more because my son is a big Lego fan. He likes building things. And so he likes the building aspects of it more than the breaking aspects of the birds.
Great. Well, thanks so much, Rich.
Thank you, Lena. I appreciate your having me.